Are you looking to get into the Melbourne property market in 2024, but feeling confused on where exactly to start and if it's even a good idea? Don't worry, we've got you covered. This episode features 5 different property experts, all talking specifically in the field of their expertise around the subject of buying in the Melbourne property market. Think of it like your own expert team we've assembled for you. Kicking things off with mortgage broker and property investor Max Phelps. Max knows a thing or two when it comes to the finance involved in building a portfolio.
If the locals can afford to buy the properties, then there's probably upside potential in their market.
Next, we want to speak to an accountant. We've got Jeremy Iannuzzelli, property investor himself, and an accountant to some of the wealthiest investors in the country, breaking down what we need to know about Melbourne right now from an accountant's perspective.
I have seen this state pop in terms of growth, and when it moves very quickly.
Then we jump over to buyer's agent Steve Ash. Steve's built himself a $10 million plus portfolio, but has a unique twist in the way he builds things. Coming from an investment banker and superannuation background, we talked to Steve about the importance of portfolio construction in Melbourne.
We all don't know it's a finance game. There could be a bit of pain for a few years, but I do know that's the place where I'd like putting my money into.
But what if you're wanting to add value? We've got that in the team too. We talked to Flux, creator of the Property Developer Network, to talk about what developers need to look for if you're trying to enter the Melbourne market and manufacture huge equity growth.
Victoria has been projected to grow from 7 million people to 9.4 million people in the next 20 odd years.
And finally, last but not least, head of research and founder of InvestorKit, Arjun Paliwal, shares the details of what all the nitty-gritty data is telling us about Melbourne right now.
Out of the 8 capital cities, we've ranked Melbourne number 3 for infrastructure per capita. I would say right now trends have shifted, so that's a
Any investor that's serious about spotting an emerging market has been thinking about Melbourne in 2024. But are we still way too early to the party? And what are the details you really need to know? My name's Todd Sloan. This is the Pizza and Property Podcast, and you're listening to the chat with my expert lineup: Max Phelps, Jeremy Iannuzzelli, Steve Ash, Flux, and Arjun Paliwal. Max Phelps, how are you, mate?
Mate, always good to see you.
Mate, likewise. It's always good to talk borrowing power with you because you're a man in the know when it comes to how much people can actually grow their portfolios from the finance perspective, which, well, let's face it, it's one of the most important perspectives because it doesn't matter if you've got all the knowledge in the world. If you can't get the money, you're not going far very quickly. So before I actually jump into all the questions around our 3 main topics for if someone wants to buy in Melbourne, is there anything you wanted to say first or kind of set the stage with of your thoughts on Melbourne and Victoria? Or?
Yeah, so when it comes to borrowing, I know as investors, we look at how much money can we borrow as an investor. Mm-hmm. But as an investor myself, as a professional investor, I look and see what can the locals afford? Because if the locals can afford to buy the properties and pay more, then there's probably upside potential in their market. If there aren't locals that can afford the prices, then it's just interlopers like you and I and your audience that are coming in and driving prices up, but that's not necessarily sustainable and not necessarily a good thing.
Okay, so if you're looking at a market and going, people already can't afford this, then like in local terms, then it doesn't matter what people can afford outside of the locality.
Correct. We can distort the figures, but they're going to come back at some point to some level of equilibrium where local people can afford to buy the local houses.
Well, from the mortgage broking side of things, if someone's looking at buying in Melbourne right now, can we talk about the first one, which is borrowing power? What do people really need to consider?
Yeah, so when we look at what locals can afford to buy at in Melbourne, Sydney and Melbourne tend to follow the pattern of the more that they can borrow, the more people bid up the prices, and that's where the market sits. And so going back a couple of years to when interest rates were only a couple of percent and banks were assessing borrowing power at 5%, then the average couple in Melbourne were able to buy for about $1.2, $1.3 million. Mm-hmm. And that's kind of where prices headed to.
Okay, yep.
Now, we then saw a combination of APRA telling the banks that they have to use a 3% buffer on interest rates. And then immediately after that, interest rates going up and up and up and up and up and up. So that now banks are assessing borrowing at more like 9% versus 5% going back a few years. And that smashed borrowing power by about 30%.
30%. So we've gone down from 1.3, just quick math in my head there, to what, like 900-ish?
So it's actually we dropped down to about kind of about 1.2 to about 900, but then we've gradually built back up as wages have gone up. So we've had wage increases the last couple of years of 4%. Mm-hmm. When wages increases of 4% and inflation is 8%, borrowing borrowing power doesn't improve, but that's not the case this year. We've got a 4 and a 4, close enough.
You were talking off air before, you and I were just chatting about how Sydney and Melbourne a lot of the time is linked to that borrowing power. And often if we get an extra 100 grand to spend, all of a sudden Sydney and Melbourne kind of drop by 100 grand. What I'm hearing here is, and I know we haven't got you on as the data guy for this, but it's like a data point maybe to watch or something to really keep an eye on, is as soon as that borrowing power increases, if APRA start laxing things and banks can lend more, that's going to be a really good sign to watch.
Absolutely, yeah. So, and we're likely to see more. The only problem is that historically, Sydney and Melbourne have both moved together. They both hit that 1.2, 1.3 level, and then borrowing power plummeted. Sydney dipped a little bit. Melbourne started falling and carried on. And so a lot of people are saying, oh, well, Sydney's a lot more expensive than Melbourne, therefore Melbourne has to make up the difference. I don't see that, not from the locals anyway, because from a local borrowing power perspective, we are at around the equilibrium of where local people can afford local property in Melbourne. Local people in Sydney cannot afford local houses in Sydney. We are about 25% off the mark.
Mortgage broker hat off, investor hat on for a second. You're basically looking at Melbourne not through the lens of here's this incredible opportunity. You're like, it's actually probably at a reasonable price point already, if I'm hearing it right. Yeah. Okay.
And I'm still looking at other states to go, well, they're not at their borrowing power. In other words, the locals could afford to pay more and bid those prices up if they want to compete against the interlopers that are all diving in those markets. But again, when we've got such huge populations of Sydney and Melbourne, if investors from Sydney and Melbourne start jumping into Perth or Brizzy or Adelaide, they're going to have a massive impact there, and they can drive the locals past their point of what they can afford, which is kind of what's happened in Sydney at the moment, probably more with international money coming in, which has kind of pushed the prices beyond what local people can afford.
And this is what I find very fascinating about Melbourne right now. It's like it's almost this 50-50 split of people going, nah, it's not an opportunity, and other people going like, oh my God, it's opportunity. And it sounds like you're on the fence of like, not that it's not opportunity, but you're not seeing the massive undervaluation.
I see very little downside risk, but I don't see a big upside risk. So an upside risk would be if the median price was sitting at about 800, 850, I'd be going, this is good. People can afford to spend about 960 now. So therefore they can afford to spend more. Let's jump into Melbourne. But we're not. We're seeing, median prices around about that what people can afford.
Talk to me about rental yields, because I know that's one of the things that holds a lot of people back from Melbourne.
Yeah, well, the rental yields, I don't know why. It's always been garbage in Melbourne. I've been 15 years in the industry, and every time we look at Melbourne, we go, those yields are rubbish.
I like how you sugarcoat it, Max.
Well, they are. They're just significantly lower than the other states. And even, what we've seen is we've seen prices surge in some markets, but rents have also surged. To a certain extent, rents have grown and improved the yield in Melbourne somewhat, so that the picture's not as bleak as it normally is. But it's still not hitting anything like what we often see is yields getting up around when a market is undervalued, we often see yields getting up to about 5.5%, 6%. It's when the market's a bit stinky, no one's really investing there, and rents keep going up, and eventually rents get to about that 5% plus mark. And that's when you start to go, all right, well, yields are over 5%. Maybe there's room for prices to go up. Or more rental growth is just going to push that more and more out of whack. So eventually we might see growth that way. We're still not getting there with Melbourne at the moment.
What do people need to know from a borrowing perspective with the yield? Because if someone's really wanting to expand a portfolio,
we can't talk about yield without talking about costs.
Okay.
So if I go back, probably only not even 5 years, less than 5 years, banks just used the rent that you get. They took 80% of that, and that was the figure that they used. So they assumed that costs like agent fees, vacancies, council rates, water rates, and so on added to about 20%. And that was a fair assumption based on ATO data.
Okay.
Now then, banks were told you can't keep using that 80% figure. You've got to actually find out what the real costs are, because some people are paying extraordinarily high strata rates or something like that. So now all of the banks require you to input the costs of the property as well as the rental yield. So when we're putting them into a lender servicing calculator, we're putting in the rent, but we're also then estimating what the costs are. So the Melbourne rents are not quite as high as some of the other states from a percentage perspective, but then the costs are often higher, and that's because we know that we've got the most importantly land tax. If you're an investor buying in Melbourne, you can't really tell the bank that, oh yeah, no, I don't have any land tax to pay.
Yeah, what does it start at, like 30 grand or something?
Talk to an accountant, but I believe it's 50 grand for an individual, or 25 for a trust.
Yeah, so it may as well be zero.
It's close to. So you're going to pay land tax where you're not going to pay it in other states. And then you've got the other costs that are likely to come in as well, with the costs of compliance with regulations and so on. So it's much harder to actually put stuff into a lender calculator and get a positive outcome when you've got to throw extra numbers in there.
Okay, so someone's coming to you and they're like, Max, I'm keen, I want to buy in Melbourne. What's the most you can get me? Like, what are the kind of things that you're sort of saying, well, look, you're going to need to get this kind of yield, but you're also going to need to make sure maybe you avoid these kinds of costs. So it's actually more about the cash flow rather than just the gross rental yield, because like you said, that can look more attractive than it actually is. What else are you kind of telling them box-wise?
And especially when, we know that most investors that want to be serious about investing are having to use trusts. That means that those losses that you make in the short term are kind of locked in, and you can't get the tax back on those. So we have to make people aware that when you're going to buy in Melbourne, then expect that you're probably going to be running a bigger loss for a longer period of time than you would be in other states.
Okay. So it's basically just buckle up. And if you want to get into Melbourne, just know that there's going to be a bit of a loss period. That's kind of what I'm hearing. It's not the fun stuff.
And don't forget the extra cost of getting into Melbourne, because stamp duty is the most expensive in the country.
Geez, we're painting a bleak picture to start with. Okay.
Well, we honestly, I'm an investor. We've got buyers in the group, and we've got people investing. We were jumping into Brizzy in 2019 and jumping into Perth in 2021. And going, yeah, we've got to do this, we've got to do this. And we're looking at Melbourne. Oh, this looks like there's opportunities in Melbourne. And we've run all the numbers and just gone,
All right. Let me, because we're coming to the pointy end of things now, but let me just ask you a quick question. What would you need to see in Melbourne, again, through the lens of a mortgage broker, from the lending perspective, to go, yeah, opportunity. That's what I'm after. Yeah,
so I'd like to see a combination of a drop in rates and a lowering of the APRA buffer, that 3% buffer.
Okay.
To understand that 3% buffer, you've got to go back a bit more time to 2016, when the average lender was using a 1.5% buffer. So banks were using a 1.5% buffer. Then they were made to use a 2.5% buffer in late 2016. And that's when we saw borrowing power in Sydney and Melbourne, well, borrowing power drop, and Sydney and Melbourne start to dip. And then they recovered again. 2016, 2017, they dropped.
Sounds about right.
2019, we saw, and there was also a floor rate put of 7% that the banks had to use to assess you. They dropped that floor rate down to 5% when the interest rates were sitting at about 3%. And so suddenly it jumped, borrowing capacity jumped back up again, and we saw Sydney and Melbourne recover. Then we had that right at the end of 2021, just when the markets were all running hot, they slyly introduced this 2.5% to 3% jump, which didn't have any impact at the time because interest rates were around 2%. So 2 plus 2.5 was 4.5, and the banks had a 5 minimum. So 2 plus 3, we've still got a minimum of 5, but now we can't go below that. But that 3% is still now on top of whatever you're paying, which for most investors these days is about 6.5% plus.
So we're getting assessed at 9 and a bit.
Correct, 9.5. So I'd like to see if that comes off, then that will create borrowing capacity for Melbournians, which will then create opportunities for investors going in there. Likewise, interest rates dropping will increase borrowing capacity, which will then put Melbourne from being in equilibrium to having capacity to pay more, and they're probably going to bid the prices up themselves. But as investors, you want to get in there before they do that.
I know I just said asking a final question. I'm going to ask you one more very quick one. How are people keeping track of this? Because everything you're saying to me, that makes total sense. And it's like, yes, all right, got to watch for these changes. Like, how can you keep an eye on what APRA are doing as an everyday investor on the street?
Well, the only thing you can really do is to stay close to your broker and keep asking the questions. What's changing? Is there any changing regulations? Get an update. But they're the two things that I'm looking for to see Melbourne look exciting. And then other than that, we're just in, once we hit equilibrium in terms of prices versus borrowing capacity is about right, then a 4% growth in wages ought to lead to about a 4%, 5% growth in property values. So it makes it solid value if you can stomach the extra stamp duty to get in, the land tax costs, and the lower yields of holding that property in that state.
And keep your eye on what's happening with the borrowing power side of things, because as soon as that starts increasing, we're probably looking much better for Melbourne and Sydney, or more specifically Melbourne in this case.
No, Melbourne, not Sydney. Sydney's so far out of whack that it needs everything to change just to come back. It's either got prices have got to fall, or regulations have got to change, or wages have got to rise before Sydney gets back to equilibrium.
Okay, I feel like I changed the subject too much then. Forget I said Sydney, just Melbourne.
Yeah, just Melbourne. That's right.
Okay. Max Phelps from Golden Eggs, thank you so much for jumping on the show, mate. Always love having you on.
No problem. Thanks so much for having me again.
You know, the big takeaway I'm getting from Max here is really around like the borrowing power side of things. At the end of the day, if he's saying Melbourne property market is going to go up in turn or almost in step with the amount that people can really borrow, well then this whole 3% buffer side of things, that's going to make a huge difference, because as soon as people can start borrowing more, I feel like this is kind of applicable to so much of the market, but maybe it is more applicable to Melbourne. Looking at it from this lens, to me, that's a huge indicator to start watching, because if you can start understanding one of the major drivers to why a market's going to grow from a financing perspective, it's going to give you such a leg up. But the other big thing that I'm getting from Max is the cost side of things. Investing in Victoria does cost more. There is the argument that, like a lot of insurance and council rates up in Queensland, they cost an arm and a leg in some cases. But there seems to be a lot of little costs and more getting introduced, especially from like a political level in Victoria. Something to keep in mind, really, when you're looking at that yield and how you're going to balance that out to keep growing. But now it's time to talk from more of an accountancy perspective, from someone that is an incredibly accomplished investor themselves, about how you can better understand entity types, taxation, and all of the nitty-gritty details you need to be aware of if you're thinking about investing in the Melbourne property market. It's time to chat with Jeremy Iannuzzelli. Jeremy Iannuzzelli, how are you, man?
Very well, Todd. Thank you very much for having me as part of this panel again. Really excited to talk about what is now becoming obviously the flavour of the year. It's what's Melbourne going to be doing, and what are we thinking, and what are some things to look out for, especially if you're looking to go into that market from a property investment perspective.
Absolutely. And you wearing the hat of property investor very well, but also the hat of an accountant. I think that your opinion is going to be probably leaning forward to the screen a little bit for everyone watching, mate. So I know you wanted to cover off a few different parts when it comes to Melbourne. We're talking land tax, state government changes. We're talking about structures in Melbourne, and we're also talking negative gearing. Is there anything that you wanted to kind of set the stage with before we started to jump into the land tax side of things?
Yeah, I think it's important to understand that Victoria at the moment is what one would call, and it's funny I say this, an emerging market, because it's been flat for such a long time, and it's been really negative for investors, especially during that pandemic period, just with a lot of legislative changes and backflips from the state government. A lot of negative, I suppose, negative connotations around Victoria as a state of investment, considering when you start to look at other places like WA and Queensland and the strength that they've had over the last 4 years. But it's really important to note that each state is almost like a brand new country, and there's so many different rules within each, and investors really need to understand and educate themselves on what they actually mean for you, what they mean for your back pocket, and what they mean for your property investment journey. So these are things that I look at as an accountant that really will dictate and determine the type of property that I'm buying in that state, when I'm buying in that state, if I'm buying in that state, and more importantly, the outcome that I'm looking to achieve based upon a different strategy that I might take, whether it's a buy and hold or maybe a buy, build and sell. But I think the first thing to really note, Todd, is land tax. And I know that's been the flavour of the year for Victoria, and it's been at the tip of every investor's tongue, whether a professional investor, sophisticated, or just a novice early investor. But understanding what land tax is very important. And I think we'll start by saying that it is a tax based upon the land valuation that you hold in that state. It's not necessarily just for homes sitting on dirt. It is a proratement of units sitting on the value of the land. So if you've got 10 units on a block of land with a Commissioner General valuation of $1 million, then your unit has an entitlement of $100K, which in today's terms for land tax in Victoria means that you'll be spending about $500 in terms of land tax yearly. So it could be equivalent to 1 week's worth of rent, Todd, or maybe a couple, depending on the level of income that your property's renting for per week. So land tax is quite important, and it's come through some state government legislative changes where originally for many years it was sitting at about a 250k threshold, meaning you could own land with a value of 250k or less and not pay land tax. It went up to 300 grand for about a couple of years and then went straight back down from a personal investment point of view to $50,000. So it's a $500 cost that a lot of people now have, and potentially a $975 cost if your land sits between 100 grand and 300 grand that you did not have in the last couple of years. So it's an important factor to understand that land tax is now a cost for many property investors in Victoria, given that the land valuation threshold for land tax is so low. So it's important to note that you could be losing 1, 2, or maybe 3 weeks worth of your rent in land tax.
Can I just jump in with a quick question, mate? So is it the same in a lot of other states where it just kind of like ramps up crazy as well? Like if you've got one property, I hear you, and you're saying like around that, let's say $1,000 a year kind of tax, if it's got around a $300,000 land value. What if you've got 4 of those properties? So you're actually holding 1.2 million in total land value. Are you paying $4,000, or is it like ramp up to like 6, 7, 8, 9?
It does start to really ramp up. So let's just go to your example. If you've got $1.2 million worth of land value held across those 4 properties, you're looking at about $8,163 as a cost straight away.
It's huge. Plus
1.275% of every dollar above 1 million. So again, just to confirm, $8,100 straight up upfront cost plus 1.275%. And many states are similar. The percentage starts to ramp up with more land value that you do hold. So it is a tax on the wealthy. It is a tax on the people looking to gain a lot of wealth through property investment. Their basis in theory, the state government that is if you can afford to have that many properties, Todd, you can afford to pass go on the monopoly board and give us a little bit more money, I suppose.
I thought when you pass go, you get $200. You don't give $200.
Yeah, this is the different rules. This is the state government monopoly. Every time you pass go, you hand them 200.
Melbourne monopoly.
There are a couple of things to note. There's so many other things like trust, for example. Some states are fantastic from a trust perspective with land tax thresholds, such as WA and Queensland, and as we know, Northern Territory, no land tax as well. But another thing to note, Todd, is that the different thresholds for trusts in Victoria. Most states, there's some really good thresholds like Queensland and like WA that we get some concessions on. So when we hold property there, there's very little or potentially no land tax. Obviously, it gets up there when we start to hold more properties. But in Victoria, 25 grand your threshold, so which is peanuts. And any land you hold with a value of 25 grand or less, no land tax. But if you hold a value of land between 25 and 50,000, there's an amount of $82 plus 0.375% for every dollar above 25k, and between $50,000 to $100,000 you pay $76 compared to $500 for a personal. So trusts do get taxed a little bit extra when you are taking land tax into consideration. So that's something to really note. Structure, yes, there might be some benefits attached to it from asset protection, tax, and potentially borrowing, but there is a little bit of a cost of going into a trust in Victoria, and that's that additional land tax that you need to pay. While it may not be a lot, it is something to take note of.
Yeah, I'm really hearing if you're wanting to buy a property in Victoria, maybe a couple of properties in Victoria, the holding costs are always going to be a little bit trickier just because of the lower yield. But maybe you could probably manage that tax and start working it in. But if you're going to try and build a portfolio of 4, 5, 6, 7 in Victoria, like it sounds like you'll almost be giving one of the rents away to the government each year.
Absolutely. And but I think a lot of people need to look at the other side of the coin as well, especially in Victoria. The occupancy costs in some circumstances might be slightly lesser. So that's the insurance, the council rates and the water rates compared to some other regional cities around the country where a lot of investors are purchasing at the moment. Because quite often if you go into these regional centres, there might be specific or or catastrophic weather events that occur, multiple times throughout the year, which insurance companies do factor in. Where typically I've seen Victoria as a state, their occupancy costs, even such as property management fees as well, are slightly lower than a lot of other places around Australia. So sometimes it's a little bit of a trade-off. We win on occupancy costs, but we've got to pay a little bit extra on the land tax compared to other states around the country. So it's just really comparing apples with apples for most people when you are looking at investing in Melbourne, Victoria, compared to other states around the country, looking at the real hard costs associated with the ownership of that property. What are the things that can be variable and reduced, and what are the things that are more fixed in nature? And that's going to give you a better understanding of what my potential net yield would be on this property if it was to all be paid off. For me personally, though, Todd, I'm looking at Victoria as an investor, not so much from a yield perspective or a cash flow perspective. I'm looking at Victoria from a development perspective. I think there's a great opportunity to go into that market and look at properties where you can add a lot of value and potentially sell it, and that's where you're going to get your yield. So it's not going to come most from rent, as most people like to buy a property, hold it long term, get the rental income. For me, choosing Victoria is very much a transactional state where I'm getting into the market, doing what I need to do for the value uplift, and then selling it hopefully for a profit, and that's where I'm going to derive my return.
And we're going to be chatting with Rob a little bit more about the opportunities around the development side of things. But it's interesting to hear that that's where you're jumping into on a bit of a personal investor note, man. Yeah, very interesting to hear. So as far as number 2 is concerned, we're talking structures in Melbourne. I feel like we've kind of already moved into structures. Is there anything else you wanted to really talk about on the structure side before we get into negative gearing?
Yeah, absolutely. So structure becomes very important. So you really need to understand your business plan for that state. And I mentioned just prior, and that was a segue into this, is for me looking at Victoria as a bit more of a transaction. I'm looking to buy and add value and sell. It doesn't make sense to do that in my name or a trust, because I need to then distribute the profit or pay tax at high margin rates. So the right structure can also facilitate a good level of return. Because I look at the tax that we pay or the tax that we save as $1 saved, $1 earned, and that factors into my overall net return after tax. So the right structure with the right business plan of what you're going to be doing in that state is going to be key to success. So if you're looking at using Victoria transactionally, then maybe a company might be the best option for you, where the tax rates could be 25 to 30% depending on the passive income tests. If you've got an opportunity to buy and your plan is to maybe look to hold it for a couple of years and catch it early and sell it at the top, if you can time the market well, then potentially a trust might be the best play for you, because you do get a 50% discount when you hold the asset for longer than 12 months when you distribute it to various individual beneficiaries. But if you're looking to hold this property long term and there's a substantial amount of negative gearing involved, and we'll talk about that at a later stage, then maybe buying in your own name could be an option where you can absorb and receive some of the negative gearing benefits that the government provides. So your business plan for the state and the structure attached to the business plan of what you're aiming to achieve is key in being able to really maximize the return after tax that you're going to be receiving.
Mate, that is phenomenal. If you're listening right now and you're like, that sounded kind of good, hit that rewind 30-second button a couple of times if you're on Spotify. Just pull the scrubber bar back about 30 seconds a minute if you're on YouTube, because that is absolute gold. Because if you don't know the right, like your actual plan, and then all of a sudden you're like, no, everyone's told me trust is the way to go. But you're going to go down like Jeremy's doing right now, the development route, the add value route, that kind of thing. Maybe it's not making sense for you. Or if you're going to be heavily negatively geared and you've got one property, maybe you are better off putting it in your name. This is why it's so important to chat with someone like Jez to actually understand that what's the plan. Now let's fit the best structure to it. I think that was very, very valuable, mate. Is there anything else you wanted to talk about on the structure side of things?
Yeah, I think they're probably the main things that one needs to consider. We spoke about land tax, and obviously for people out there that want to understand the tax benefit associated with each structure, I do advise you to chat with your professionals. But mostly I just want to really emphasize that the business plan attached to the structure is so key to being able to produce a higher level of net return after tax. And probably one of the most important things that people need to consider when entering into a state or entering into a new property investment environment.
We should do an episode on that, man. I'm just thinking right now, it's like same property, different structure, and like show like the tax benefits over a few years, just to like super paint the picture and illustrate it. But anyway, I'm getting distracted within the recording. Negative gearing, the third and final point, man.
So Victoria has always been a state that is commonly known as the negative geared state. Mm-hmm. The rental yields typically have been a lot lesser compared to a huge number of other states, other cities, other towns in the country. And it's always been because they really ramp up investment there and they can build, 1,000 units in the space of 6 months. And all of a sudden they flood the market with a significant amount of supply, lowers the overall rental yields, and thus it continues. So it's been a bit, I've always never understood it, to be fair, Todd, why Victoria's rents have been a lot lower compared to a large number of other cities in the country, being Australia's second largest state by population and second largest GDP as well. But what I am seeing in the state, though, to be very fair, is rents are starting to go up. So we've had this 3 to 4 years of stagnating rents in Victoria, if not some places coming down. And all of a sudden, there's been a real big slowdown in terms of development there, and things are starting to now pop. So yields are becoming a lot better, but still, I would say below par compared to a lot of other towns, states, and cities in the country. But for a lot of people out there, if negative gearing is one of those things where you're quite worried, you're quite scared that how am I going to fund this property in the long term, I'm encouraging a lot of clients to really look at PYG variations, Todd. And again, for anyone that's listening out there, PYG variation is where you get to vary. You send an application to the ATO that communicates with your employer, and they vary the amount of tax that you pay in your weekly, fortnightly, or monthly pay cycles. So that means rather than you getting a really large chunky refund at the end of the year or a moderate amount of refund at the end of the year, you're getting that throughout your pay cycles as a reduction of the tax that you pay in your pay slip. And what that allows you to do for many people that are listening and out there again wanting to invest in high negatively geared states is it gives you an opportunity to be able to hold this property long term. You're not having to really dig down the bottom of the barrel to find that last penny. You're rather getting a little bit more elevated amount of cash flow through your pay. So that's something for many people to look at. If you're going to go down the path of investing in Victoria and you're worried about holding costs, you're worried about being able to support the property, and your budgets allow for it with potentially PYG variation, that could give you an opportunity to be able to invest in this state in the short, medium, and long term for what maybe you're after as part of your business plan, which is a higher level of capital growth. Because I have seen this state pop in terms of growth, and when it moves very quickly. And on the other side now, for many investors, they've seen the stagnating last 4 years, some areas of growth and some areas of decline. So PYG variation is important. It's another bow or another arrow to your bow, I should say, that gives you an opportunity to be able to hold these properties during the more negative times of ownership, which is the rental income being a lot less than the expenses. And it gives you the opportunity to be able to hold these properties long term for when that growth comes, you're primed and ready to take advantage of it.
Mate, I love it. This has been an incredibly valuable 15 odd minutes in this episode, man. And if you guys are wanting to hear a bit more from Jeremy as well, check out, we'll link it below. Jeremy's actually got his own podcast, What School Should Have Taught You. But otherwise, Jeremy Iannuzzelli, thank you so much for jumping on the show, mate.
Always a pleasure, Todd. Thank you.
See, the land tax thing, this is very real. I think it's a lot of people's biggest gripe with actually getting into Melbourne. When it's used as a comparison against other higher costs for other states, it's like, yeah, okay, maybe that balances it out. Part of the concern would be, though, if other states are just going to follow Melbourne's model. It's really going to go one of two ways. They're either going to start pulling things back, or everyone else is going to go, hey, they're getting away with it. Why don't we do that? When I say everyone else, I mean like state governments and territories. As far as, I really like this bit though, the structure in Melbourne and like what you're really trying to achieve, whether you're looking for a real transactional type development, like Jeremy's doing himself there, putting his money where his mouth is. He's investing in Melbourne right now. But because it's more of a transaction based, he's using a company as a structure, but then looking at it going, okay, maybe if I'm really wanting to hold something longer term, then I should put this in a trust. But then you don't enjoy any of those negative gearing benefits. And as much as you don't invest for negative gearing, that's daft. If it's a benefit that you can get out of it, or if you're at that stage of the portfolio where it actually really does make a difference, then maybe holding in your own name is actually the way to go. But the other big takeaway is the PAYG variation. We don't talk about that very much. And if it's the kind of thing, let's say you're in a 30% tax bracket and you're negatively geared by $10,000 a year, just to pick easy numbers. That extra $3,000 you could get back in your pocket. I mean, I know that's probably, what is that, like $60 a week, something along those lines. It's not like you're all of a sudden rolling in it. But maybe that's that little bit that actually does help out with the cash flow side of things, especially if you've got multiple properties. So the big thing that I'm getting from Jeremy is absolutely talk to your accountant. Make sure you're asking these kinds of questions. Make sure you're having this planned out properly from the beginning. Don't jump into Melbourne and then be like, are we being transactional? Are we keeping this? Does negative gearing even matter to us? Plan that stuff out first and chat with a pro that's actually going to help you do that, that's done it themselves before. That's a huge key to it. Now, speaking of the plan side of things, it is now time to chat with former Goldman Sachs investment banker who's built a massive portfolio, so we can hear his views on spotting opportunity and value in the Melbourne property market. Let's chat with Steve Ash. Steve Ash, how are you, mate?
Yeah, good, Todd. Yourself?
Mate, very good. It's been a little while since you and I have seen each other, and I'm very eager to get your thoughts on this panel.
Thanks for inviting me. Yeah, it's good to see you again. Hope all is well on your side.
Absolutely it is, man. And so as far as Melbourne's concerned, I mean, you're looking at this through a very unique lens. It's one of the reasons I really wanted you on here. Not only have you built a huge portfolio yourself, but you come from an a banking background that I don't actually think any other BA in the industry really does. So when it comes to the portfolio growth side of things, I'm really looking forward to getting your take on how we should really be viewing Melbourne. So before we get into it, is there anything you wanted to kind of set the stage with when it comes to portfolio growth in Melbourne?
Well, yeah. I think it's a good topic you brought up. It's something I'm getting asked quite a lot by a question by the clients at the moment, sort of like, is Melbourne the right time to start investing? And kind of like the way I look at it, especially sort of like from the background, and thanks for bringing that up, is where is their current value in the market, and where should I think about putting my hard-earned money in? Brisbane's been going great, Perth's been going great, we all know that. But I look at Melbourne and I think, yeah, okay, there's a lot of sort of bad economic sort of news, and the particular area hasn't grown for a while, and that's the city I want to be looking in. Somewhere hasn't grown for a while, and I want to sort of like have a look at that and sort of investigate that more and put a property there in my portfolio.
All right. Well, breaking it up into the 3 points that you and I discussed off air before. So you said it's really coming down to comparison value, focus value, and then also the portfolio construction side of things. Why don't we start with number one? What do you mean by comparison value?
Yeah, no, it's a good point. So I'm kind of looking at it, and there's a lot of news out there, sort of like to keep buy property. If you're seeing sort of like an annual sort of 10-year sort of performance rate of maybe 8% a year, I'm kind of looking at it and thinking, well, Melbourne houses have only grown 1.5% annually for the last 5 years, and units have been flat. As a sort of like value focused thinking. On my part, I'm thinking that's the place I want to look at, somewhere that hasn't grown too much. And furthermore to that, comparison value play, what is that really? And it's really looking at sort of Melbourne's growth as compared to some of the growth in some of the other cities, such as Adelaide, Perth, Brisbane. And when I look at that, sort of like the median price growth has really been quite stagnant for houses and units over that particular time. So that's an exact area that I'd like to start looking in and sort of looking at why, and then looking at sort of like that's my starting place. That's the city I want to do a bit more work in, knowing a couple of things really. Sort of if I go and invest there, it's probably not going to grow too much in the short term, but I'm thinking from a long-term play, 10, 20 years. And if I go there, sort of I'm going to get all of that move instead of just a bit of a short of bit of the move when it does go. So that's what I'm thinking there.
Instead of finding out there's an amazing party going on and trying to join the tail end of it, you want to kind of be a part of the start of it.
Yeah, I want to be sort of starting that party and sort of getting in there.
Inviting everyone around for pre-drinks.
Yeah, exactly. Getting the hors d'oeuvres, everything. Yeah, exactly. Sort of like when news.com and all the other sort of outlets sort of get hold of it. In a couple of years, when it does start booming, I can sit there and know I've got one or two assets there which will get good growth as the good news takes off.
So as far as comparison value, make sure I've understood you right here. It's not just like, okay, Melbourne in itself is good value because like, look at what's happened. It's like you're looking at this going, well, in comparison to Perth, in comparison to Adelaide, in comparison to Brisbane, like even Sydney in a lot of respects as well, they've already done so well, whereas Melbourne's just kind of been sitting there. So you're like, compared to other options, this one's looking like it's got the most chance of continuing that growth.
That's how I look at it. Yeah, I mean, when I had my own investments in Melbourne, and 5-6 years ago, they barely moved, and these are sort of areas that are 8-9 Ks from the CBD. And we do know with property, and we saw it with Sydney in the 2000s, and we saw it with Brisbane in 2010, sort of like it can take a long time for something to ignite. I think a lot of us were quite early to the party in Brisbane, and we're waiting, I think, 5-6 years in some sort of cases. But whatever trigger it might be, it always will turn around at some point. And I think when I look at it from that value investing sort of lens, that's why I like Melbourne. Again, I know there could be a bit of pain for a few years, but I do know that's the time and that's the place where I'd like to start thinking about and putting my money into.
Well, and as far as the focus value then, if we look at this from more of like an individual asset basis, because this is what you and I were chatting about before, we're talking about some units I got sent by someone. No, like 2-bedroom units, like 25 Ks down south in Adelaide that are selling for like mid-5s now, which just seems insane. And now you're talking about places in Melbourne where you can get, what did you say before? It was like 13 Ks from town for like 500-600 grand, something like that?
Yeah. I mean, it's credible value, sort of like in that sort of western, sort of northwestern corridor, even sort of like a little bit further out on the northeast sort of side. You can get sort of houses on 600 square meters sometimes with development prospects, and just for about 500-600 grand, and that's incredible value. And if you look at sort of, obviously I'm quite active in the Brisbane market. I've obviously got quite a few properties in the Perth market, but if you look at Brisbane on its own, to try and get anything under 900K within 20 Ks of the CBD is pretty hard now. And so when we look at this and look at what you can get in Melbourne, I think from a focus point of view, that's incredible sort of buying. And we do know there's a reason for this, but it's not always going to be this way.
For anyone going, oh, what's the reason?
I think simple things, really. Sort of there was such negative sentiment after COVID. The world's longest lockdown. There was such a lot of interstate migration out of Melbourne to other cities. Some issues with Dan Andrews and kind of the local government there. And I just think people just were quite down on living in Melbourne. I mean, historically, Melbourne's been the world's most livable city. Then all of a sudden it just got knocked with all of these negative news items. And I think that just flowed on to the properties.
Almost like the sentiment's down.
Well, yeah, exactly. I think, I don't know, I don't have the numbers to hand, but I know there's a lot of interstate migration out of Victoria into the other states. And we saw that in Southeast Queensland. We got most of the migrants from there. So I just think that would toll quite a lot on the property market. If we look at the property market from a supply and demand sort of situation, when that demand's coming out, then obviously there's going to be a bit of a flaw in those prices.
All right, so focus value. Basically, if you're looking in Melbourne right now, you're looking 15 Ks from the city, you're looking at a house pretty cheap, 500,000, 600,000, 700,000. Then you're going out even further, you can probably pick one up even less. Compare that, going back to your comparison value, to Adelaide, to Perth, to Brisbane. It's just not there. Like, you're not picking it up for those prices. So if we go to point number 3, which is your overall like portfolio construction side of things, how are we kind of piecing these together? What do people really need to bear in mind if they're looking at getting into Melbourne?
Yeah, and I think, one of the big things I think about is the actual portfolio construction of your property portfolio. And I think this comes from, the background working for some of the big fund managers. If we look at what they do to try and smooth their performance returns, they have an asset allocation across equities, fixed income, infrastructure, unlisted. That might be 60% equities, for example. But then if you look at that asset mix, in equities, you've got some exposure to Australian equities, some exposure to international equities. So why do I say this? I like to apply that sort of lens to your property portfolio. So if we take Australia really as that sort of portfolio I was just talking about, equities, fixed income, and I'm thinking Sydney, Brisbane, Perth, Melbourne, you should always have a bit of exposure to each of those sort of areas. And I think there's a big argument to be had that you do need that part of exposure in Melbourne at the moment. Okay, if you've got Perth, Brisbane, Sydney, brilliant. They've been doing great. But when they do come off, it's good to have that sort of like portfolio construction where there's a little bit of funds allocated to Melbourne. And that's where I'm coming from this part.
You've just made me think of one thing that I wish I did talk about with Max from the lending perspective, which ties perfectly into what you're talking about now, is the cross-collateralization side of things. Because then if things do maybe come off the boil or potentially even go back a little bit in Perth, whenever that's going to happen, and then things go well with Melbourne, again, however the time frame works, if you're cross-collateralized, well, then your chance to move forward drastically decreases. But if you've got everything separated, then like you're saying, you can actually take advantage of the different, property clocks, for lack of a better term, that can actually keep you moving forward throughout one market maybe not doing so well and one really starting to pick up.
We all don't know it's a finance game, and you need to be able to extract equity at some point, whether it's that capital growth tap or that serviceability tap. No one knows if Perth's near the top or Brisbane's near the top, but they've had such good runs that maybe there's an argument that they are getting close to the top there. And so when they do go, to your point, where's the next area? And I think Melbourne stands well to be one of those areas. As I said, it might not be 2 to 3 years, but when it does go, in that time, you might be getting that growth from your portfolio out of Perth. But when that finishes and you've got that exposure to Melbourne, here, as we said, you're going to be the first person at the party, and then you can actually see that growth, and that's when you can extract your equity out to keep going and construct that portfolio. Yeah. I think the other thing to call out just quickly as well, we all know that the yields aren't, great in Melbourne, but in these areas, you can probably aim to try and get that 4.5% yield, which I think is achievable in these particular suburbs. We do know that the vacancy rates are fairly tight there, that you will get that rental appreciation, and these propositions will look even better, from an investment point of view, because yields have always historically been quite low in Melbourne. And so if these do tick up a little bit, it makes it more of a compelling investment option.
Mate, I love it. So looking at other states, other cities in comparison, it represents good value. Looking at assets in isolation, they represent really good value. Looking at it from a portfolio construction point of view, you're looking at this from almost like a diversification play and going, all right, this might be too early. Like you said before, you might be a year, 2 years, whatever it is, too early. But when the others start coming off, this is tipped to be in a very good position to be the one that starts coming up. Have I summarized you about right there, mate?
I think it's perfect. And I think the one word you use there, diversification, is perfect. And sometimes you need to sort of zig when others are zagging. And by zigging into Melbourne, having that diversification, having that exposure, every time I bring up Melbourne, I want to buy in Brisbane, etc. But when it does go, you get that whole move. It's hard to hold. It's hard to do what other people, aren't doing, if you will. But that's how you make money. That's always what I've tried to do when I've constructed that portfolio. When I think Sydney's overvalued, I look for the next item. Okay, I don't always time it right, but I generally get the value and I generally get the whole move. And so I think that's a good way of surmising. So.
Love it. Steve Ash from Property Strats, thank you so much for joining us, mate. Really love having you on the panel.
Pleasure. Thanks a lot for having me, Todd, and have a good day.
This is the big thing that gets me as well. It's the comparison, and Steve and I are actually talking quite a lot of detail about this off air before. Like looking at some markets where they were absolutely the slow goers, like Adelaide, where I'm from. You're looking at some like buying units for like in the 500,000s now that are like 20Ks from the city. It doesn't make sense. And you're looking at some of the houses in Victoria. And given, yes, not all of them are in great locations. Some of them are in locations that maybe you would not want to live. Doesn't mean they can't make good investments. It doesn't mean that if you do your due diligence and stack everything up correctly, they can't make money. Because right now, comparing just Adelaide and Melbourne, don't even worry about comparing any other state. There is a huge disparity in price. And from the time of this recording, I believe if Adelaide keeps growing the way that it is, according to CoreLogic, it's about to overtake Melbourne's median house price in something like a month. I don't think that's ever happened in history. So far, the big thing that I'm getting out of this is one of the tipping points from Max, looking at like, okay, when people can start borrowing more, that's going to be a huge key for Melbourne. Looking at the structure of the side of things from Jeremy, making sure that you have got an absolute solid plan before you purchase anything, because otherwise you're going to maybe be looking back going, okay, now we've got this huge tax bill, or now we can't get this benefit, or now we get whatever it is. Make sure you understand the direction you're going first, and then set everything up so the pieces are all like in your favor. And from Steve, the big thing I'm getting here is spot the opportunity, because it's not everywhere in Melbourne. There's still I'm sure there's still plenty of overpriced junk that you wouldn't want to touch with a barge pole. But if you can actually balance the cash flow, if you can understand the risks, the extra taxes, the everything else, there is potentially some massive opportunity here. Like Jeremy said, when it moves quick. And whilst we always say this is not financial advice, please seek independent professional financial advice from a qualified professional. You need to take this kind of stuff to them, because I can't help but think that for everyone saying like, nah, don't worry about Melbourne. Melbourne's done. It's cooked. Just reminds me of Perth 3 years ago when everyone was saying that. 2 years ago when everyone was saying that. Reminds me of Logan when everyone was saying that again 3-4 years ago. People used to look at some people investing there just, nah, you're cooked. You don't know what you're doing. And now some of them have literally the biggest portfolios in the country that we've ever spoken to. Is Melbourne that opportunity now? That's the big question that we're going to continue talking to experts about with next cab off the rank is Rob Flux, because maybe you want to add some value to this. Maybe you're looking at it thinking, I can't wear those holding costs, but maybe if I force some value through splitting a block off, selling the backyard, hey, maybe now we're in business. So let's have a chat with Rob Flux and find out more about a developer's perspective on investing in Melbourne in 2024. Rob Flux, how are you, mate?
Not too bad, Todd. Welcome back, I feel like saying, but it's you inviting me back.
Mate, we're always happy to have you on the show, and especially today, because I know you say you're not too bad, but I do appreciate you still keeping the appointment to chat on the episode today, because I know you're feeling a bit under the weather, mate. So if we can power through this, smash out as much info that you've got as possible when it comes to Melbourne and developing. There's a few points that you wanted to talk about, but some of it, you and I were chatting a little bit off air, very, very information dense. And if you're listening right now on iTunes or Spotify, make sure to head on over to our YouTube channel. You're still going to be able to follow along, but you'll get a bit more of it if you can actually see this as well. There's also going to be a few links in the show notes too. But Rob, is there anything you wanted to kind of set the stage with first before we get into it?
I might kind of take a 10,000 foot view. Let's just ignore Melbourne for a moment and just look at the role of the property developer versus a property investor. A property developer is someone who puts an opportunity in front of the audience or in front of the consumers before they know they actually need it. So we have to do a lot of things that are predicting the future. Now, by way of example, if we go back 250 years, Australia was a one-lot land subdivision. And so every road, every school, every house that's been built, every shopping centre has been a developer putting an opportunity in front of someone before they realise they actually need it. So our role is to predict where are people actually going to go. Now, the good news is that the path is laid out in front of us like a red carpet. And that's because the state governments in every single jurisdiction plan ahead where these people are going to go, because it's super expensive for them to build roads and highways and hospitals and things like that. So they plan 20 and 30-year plans, and they tell us this is where we want people to go. And they're going to spend billions and billions of dollars on infrastructure to activate these areas. So when we understand how to interpret those plans, then they've laid out a 20 and 30-year roadmap for us to know, hey, if I put that opportunity in front of someone right now, will they actually go and take that up? So then it's just a matter of test and measure where we're at all the time along that path.
Okay, can we start with how do you actually find that info?
It's about understanding, I guess, it's done in every single state, but it's usually going to be called a strategic plan. Okay, now, the Melbourne strategic plan, for example, or the Sydney strategic plan. So when you actually start to understand the terminology, you can start to search for it. Now, in Melbourne in particular, okay, it's actually called the plan.
Creatively named.
And it's the plan for growing the city into the year 2050.
Okay.
Now, so it is a long-term vision, and for those of you who don't like reading government documents, it is quite a boring read, except if you know what you're looking for. And I'm going to give two key phrases that I want everyone to start to pay attention to.
Okay.
So a thing called a growth node.
Growth node, yep.
Growth node, and one called a transport corridor.
Okay, transport corridor.
Now, a growth node is going to be like a mini CBD. So there's going to be a whole bunch of centralization. There's going to be jobs there. There's going to be, shopping centers and activity. So that's where you're going to get a whole bunch of density. And then the transport corridors is how they go from one growth node to the next growth node so that they can travel between areas. Because it's super expensive to build a highway and super expensive to build a road. But when you get there, you want a destination. So when you understand those two, that's how every single city in the entire world is built, is understanding growth nodes and transport corridors. And when you get to look at the infrastructure projects that are happening, they're largely building the infrastructure that is the transport corridors. How do we actually get people from point A to point B? And sometimes point B has not yet been activated.
Gotcha. Okay. And is this where the map that you and I were going through beforehand comes into play to kind of visualize this?
There's a plan, which is the map for where they want the city to grow to by the year 2050. Now, it's a very, very high level plan, and I'll just share that on screen momentarily just for everybody to see. And what we can see here is all these red dots are the growth nodes that we're actually starting to talk about. And you can see the purple lines, I guess this dotted line here, these lines here, these are all the transport corridors that are actually starting to connect different areas to each other.
Okay, and just for anyone listening, if I can just quickly jump in there, Rob. So some of the growth nodes are Sunshine, Broadmeadows, Epping, what do we got here? Box Hill, Ringwood, Dandenong. So we're talking not all stuff that's like sort of 40 Ks out. Like Sunshine's pretty close in.
Sunshine's pretty close in. And you'll notice also that there's, in this instance, some orange little clouds, for want of a better word, that sits over it. And you'll see there's 6 of these orange clouds that exist. And they've all got the an acronym or the NEIC. That's a National Employment and Innovation Cluster. So that's where there's going to be a whole bunch of density that's going to create jobs that are going to sit in and around the area. So there's 6 of those major ones, plus all the growth nodes that are sitting around everywhere. And so it's really looking at, well, if there's going to be billions of dollars spent and they're trying to herd them into those areas, the question now is, have they started to move there? Now, when we start to talk about cause and effect, the developers start to build the infrastructure or build the supporting work around the primary infrastructure. It's called trickle-down economics. So the government's going to spend billions of dollars building a road, and in doing so, there's a whole bunch of jobs that are actually created. Now, in building that infrastructure, those people want to live somewhere near there. So then the developers start to come and put some housing in that place. And so now the person that's building the road and building the highway and that sort of thing can live somewhere close to the work while it's being built. Now, whilst we start to build that, the next thing is that the builders start to employ jobs, and so they start to employ people. Now, everybody starts to spend money in the area. So now people start to spend it in the local shops, the local newsagent, the local donut shop, local Bunnings, all that sort of thing. So now those businesses can start to employ people. And so what happens is it starts to get this groundswell where then people start to actually move there. And once it gets to the point of critical mass, at that point, that's when the investors start to see the impact of that. And so, but the developer actually created the opportunity in the first place based on the state government telling us where people were going to go.
So looking at where everything is at the moment, as far as these infrastructure projects, as far as the timing of the market, but then looking further into the future, it's laying the groundwork to be much more attractive for investment. What are you looking at as far as the timeline's concerned? Is this kind of going, all right, you might still be sitting on pretty stagnant growth for the next couple of years if you're not developing, if you're just investing?
There's a couple of factors that start to play in here. So firstly, there's the natural population growth that's actually going to happen. And Victoria as a whole has been projected to grow from approximately 7 million people to 9.4 million people in the next 20 odd years. So that roughly works out about 122,000 people a year.
That's a lot.
That's a lot of people. They've all got to live somewhere. Majority of those are going to be living in the greater Melbourne area. So it's probably 80 to 90,000 people of those every single year are going to be net migration in. The challenge that we had is we've had a couple of things that have gone against Victoria in recent past, which has created a trend which will be reversed, but it just kind of needs to be slowed down a little bit. So you guys were locked up pretty damn hard during COVID and got sick of that and wanted to get out of Dodge really fast, right? And that started a trend to get everyone going up towards where I live, towards Queensland, and also over towards Victoria and Adelaide and other locations.
I thought you lived in a plane, mate. You're everywhere all the time.
I do live in a plane, I'm sure of it. So that created a little bit of I guess, a stream of outbound people. But the government is compensating for that by saying, well, in the short term, we're actually going to take in more than the projected 122,000, and they're trying to get somewhere in the vicinity of 190,000 per year for the next 3 to 5 years, just to kind of compensate for that and break the trend, okay, and get us back to where we were actually going to go. So there's a whole bunch of people that are going to come from international migration, and they need somewhere to live. So the plan is still the plan. That's not going to change. But they've had to tweak the plan along the way because there was this road bump along the way.
So you're not looking at this, Rob, as like, all right, it's a year away, it's 2 years away. You're just looking at this looking at the demand that's coming in, what's already there on the supply side of things. It's not a matter of if, it's a matter of when.
Absolutely. And there are currently, at this moment in time, approximately 200-ish projects that are currently underway, infrastructure projects by the state government, that are driving that demand. So the demand is coming in, but it's activating those areas. And so it will take a little bit of time for that to actually start to engage, but it's inevitable that it's actually going to. And the most obvious question that people are actually going to ask is, where do I find out what these infrastructure projects are? So if you go for Victoria, and you have a similar website everywhere, for Victoria, if you search for bigbuild.vic.gov.au, it'll give you a list of all of the projects that are currently underway. And every single one of those projects then has a spin-off page that actually gives you the information with regards to where that's at, from a planning stage to a budget stage to hey, we've started to roll it out, that sort of thing. So it's going to map it all out for you. But it takes a little bit of homework to actually understand which areas are going to happen first.
Brilliant, man. And I like the way that this, realistically, you're looking at this from an investment point of view, but then if you were to take more of a land banking approach, and then all of a sudden you're buying blocks of land that are 700 odd square meters within these growth nodes, again, not if, when, from the viewpoint that you're taking, then being able to actually knock it down and build 4 townhouses on there, there's some serious equity gains to be made if you play your cards right.
Yeah, if you want to supercharge your investments, then understand property development. And you can start land banking in areas that are going to later on become medium to high density type areas that today you can buy and cents in the dollar. And so as the demand starts to push out towards that direction, eventually you might not be wanting to be a developer today. You might want to sell to a developer at some point in the future, or you can use that time to educate yourself and then start to turn one key into many, many keys.
Love it. Rob Flux from Property Developer Network. Thank you as always, mate. And an extra special thanks, mate, for actually jumping on while you're not feeling the best.
All good, mate. Glad I didn't die on screen.
I'll see you next time.
See ya.
You know, the thing I kind of like about the way that Rob's approaching this is the whole, like, it's really not a matter of if, it's a matter of when. The corridors, he's coming at this, he was always crossing over into what I think we're about to talk about with Arjun, but just like the amount of research and due diligence that Rob's going into with this, and the way that it's like, let's just chase all of the plan. Let's chase all of the billions of dollars that are being spent here. Let's look at the amount of population growth that's happening. Let's like have a look at how many dwellings are actually being constructed versus how many people are moving in. What was it, like 80-something thousand per year? It's a lot of people. Like it's a lot. Like just listening to Rob has just made me think, like, yeah, I feel like it's not a matter of if. Like, do you really think we're going to fast forward the clock 10 years to 2034 and every other city is just dominating and Melbourne's just this dud where no one wants to live? I don't think so. Looking at and please do click on all this because we're going to have this linked in the show notes below. Deep dive into everything that Rob's linked below, or we're linking below. He's given us the links to this. And I can guarantee you probably like 95% of people aren't going to do it. But if you really want to understand that detail, it's going to be a bit drier, but oh my God, you could become an absolute expert in where these growth corridors are, where if you're looking to add some value to a property, or like Rob said, maybe you don't want to do it. Maybe you want to be the one that buys it and then sells it to a developer in 5-10 years time. Understanding that side of things could be an absolute game changer when it comes to investing in the Melbourne property market. But now we're up to last but surely not least, Mr. Arjun Paliwal. Let's have a chat with him and see what the detail in the data is telling us about the Melbourne property market. Arjun Paliwal. How you going, mate?
Good, my friend. It's been a minute and great to be back.
Mate, it has been a little while. I'm sure I'm not the only one that's excited to see you jump back on a panel. It's been wonderful to have Jung around. I'm sure we'll see her again, mate. But getting your wise words and take on the data side of things for Melbourne is going to be a very valuable conversation for a lot of people to listen to. So before we jump into the questions, is there anything you wanted to set the stage with it all, mate?
Well, I think the key thing is today just setting the stage on the data where people can learn about the indicators that decide on whether a market's turning, what is the outlook for a market, and what needs to change for that outlook to come true.
Well, if we can jump into this from the data perspective then, as far as what data are you actually looking at right now to even assess Melbourne, whether it's too early, too late, wherever, well, not too late, certainly, but you know what I mean?
Yeah, sure thing. So look, I could go on for a fair bit, but I want to simplify it down to a few things, right? Firstly, when someone's talking about a cycle in a city, starting to demonstrate opportunity, we want to look for change. And I know that sounds simple, but if something is constantly falling or constantly weak or constantly demonstrating trends that aren't going the right way, you can't just say that it's now going to look good because nothing's changed. So what we're actually looking for is that whatever that made it weak, are we seeing change in the other direction? And some of these metrics that can demonstrate that are speed to sell. So are things getting a little bit quicker or at least stabilizing in how long it takes someone to sell a property, days on market? Another thing can be sales volumes. Are people not transacting and now the changes, they are starting to transact more? Another one can actually also be the level of stock or housing inventory. Was there a higher proportion of stock available for sale in comparison to the actual sales happening? And is that the same or is that lowering? And so the key thing is if we can start to see change across these metrics, which I'll go into as well today, then of course that's going to be a sign of things to come.
Okay, so you're looking at basically, as a bit of an overview, speed of sale, volume of sale, and it's really around, are these metrics staying the same or are they changing? Because if they're not changing, like the saying goes, if nothing changes, nothing changes.
That's it. You nailed it, right? Because if we put data aside and just talk as a casual chat, I'm selling my property and it's taking longer and longer to sell. No one seems to buy and I can't seem to do a deal. And there's more folks around me trying to do the same, but they're unable to do it as well. Unless that changes, how does price rise? So the idea is not to be seeing it just for a little bit. The idea is to rank it in confidence levels. So we can spot a market turning, but we might say our confidence levels are maybe 30 to 50% because we see some things changing and it hasn't changed long enough. And then we might see those indicators create a huge turn the other direction. We're about 50 to 70% that something new is happening here. And then if we see all of that and on top of it, prices actually rising, the demand now translating to price movements, then our confidence becomes high. So the trends to catching a market early on in its cycle are possible, but it's just about confidence building and how much that's actually going to happen.
What I feel like we may have answered question 2 then indirectly through question 1 is what are the indicators that are really saying, no, it's too early?
Well, maybe instead of what are the indicators which we've answered, I might go into what some of the indicators are showing.
Okay.
And I wouldn't say it's too early. I have, there are parts of the region that you could say are slightly early, but I'd say it's not too early necessarily. And this is where it more depends on an investor and how much confidence they want, alluding to my earlier point. And I'll give you an example using another city, and then we'll come back to Melbourne with actual data points.
Okay.
So if I go to another city and talk about Brisbane, someone could say in 2018, are you too early to Brisbane? Because between 2018 and 19, was there this groundbreaking performance?
No.
Oh, no. Was it better than what it was doing in 17 to 18 or 16 to 17? The answer is yes. In 19 to 20, again, was there groundbreaking performance? No. So if someone did not know what the next 4 years presented post-COVID, they could look at 2018 investor, go, you lousy investor choosing Brisbane in 2 years. It hasn't boomed like you said it would. And then the next 4 years, go follow what happened there, right? So to one person, it could be early. To another person, it could be, I negotiated well. I found the city really easy to find the property I wanted. I bought in the area I wanted. I paid the right price. And I feel like I got some decent rental yields. And, I controlled most of the outcome. So if you miss out a year or two in substantial growth, but then you catch the cycle before anyone else does, I don't think that's too early. that's a comforting decision. I controlled the decision I made on buying the property. I didn't feel rushed, didn't feel a high level of urgency, and I was able to get in, negotiate the right price, and benefit from the rest of the cycle. But then there might be someone else who goes, no, I want to buy in 2020 when it's just about to pop off, and next 6 months we're popping off in all directions. So I think that's hard to demonstrate the too early part. But now coming back from that example and going to Melbourne, let's talk about a few things. So firstly, between April 23 and about November 23, we see days on market for the city of Melbourne or Greater Melbourne really start rising. But then from November 2023 all the way to June 2024, there is a slight rise, but it's much more stable in the curve than it was throughout the 2023 period, right? So that's the part of speed to sell. Is it great all of a sudden? No. But is it getting horribly worse really quickly? No. It's starting to stabilize. So that's the first trigger that we're looking at. The second trigger we were looking at is the sales volume. So sales volumes are up 13.4% in Melbourne. So there's an increase of transactions happening. Now, if you look at April of 2023 to August of 2023, sales volumes are actually falling back. But then from there on, all the way till now, more and more transactions are happening in this area. As a result, stock levels, inventory, sales volumes, and actually what's for sale was negatively moving. So it was going the wrong way. It was going up, which is not good. That means less transactions are happening in comparison to purchases from May of 2023 till Feb of 2024. And then inventory stabilized through to May 2024. And now June, July, inventory is dropping again. So if you look at those three indicators I talked about, it's longer selling turned to stabilizing, more people transacting, and stock relevant to transacting was worsening and then flattened, and now it's improving again. So those seem to be some good signs of change. And if you put on top of all of that, a population bleed that always, by the way, has been bad for Melbourne. When I say population bleed, I'm talking about internal migration, people leaving, but that actually has been reducing. And so it's gone from really horrible to bad. So it's gone from 2021, we had over 30,000 people leave Greater Melbourne, 2022 to about 27,000 people leaving, and in 2023, about 8,000 people leaving. So you can see it's getting better in terms of the stabilization. As we know, overseas migration has always been strong in the city, and migration alone doesn't do it. But combine all of these things I've just shared with you, and the fact it hasn't had great price growth over the last 7 or 8 years, it means that something's clearly changing. It's just confidence levels are not at the highest yet, the early stage, right? So from here, confidence level rises as things go on. More of these indicators turn in a better direction. So maybe from days on market stabilizing, it starts falling more. That's the moment where confidence has gone from 30 to 50% to like 50 to 70%, just as an example. And then if stock levels continue to fall, and then you start to see the migration improve again and again, then you start to get a few macro indicators that are starting to show confidence at high levels. And lastly, if prices start turning on the monthly and quarterlies, then you've got another big improvement on confidence. So I would say right now trends have shifted. So that's a good sign. And there is obviously potential because of how little growth it's had. To make sure you have high levels of confidence, we still need to see more and more shift to get that.
Okay, so make sure I've understood you right here, because it sounds like to still make sure you've got high levels of confidence, you need to see more shift. So it's like, it's not that it's too early, but there's still a little bit of doubt around it from what the numbers are saying. Have I understood you right there?
Yeah, it's a good summary. So it's kind of saying, hey, yes, it is an early market, which is great, because if you want to be an early and you want to be not fighting in amongst competition and you want to grab something as an early market, which we call early adopter, the answer is yes, it is early, and that allows you to actually get into a cycle before something happens. But how close from early to hot market cycle you want to be, the old 2017 in Brisbane to 2020 in Brisbane, or 2018 in Brisbane to 2020, it's just more of these trends happening. And so that's where confidence will increase. If we see another 1 year of sales volume increases and inventory falling, your confidence increases. Maybe you're now 2018-19 Brisbane. If we see another year of massively reducing internal migration bleed, then we're seeing another element there. If we see more levels of quarterly price growth or monthly price growth come into a positive territory, another sense of confidence. If we see days on market go from stable to actually falling, vendor discounting actually falling, then we just increase the confidence. So the confidence is high enough for me to say, hey, something's going to turn here in Melbourne, right? But then how high my confidence gets is more of these indicators displaying themselves to me.
Obviously, with what you guys invest into the data and the tracking and everything is insane. It's obviously a whole different level. If someone wants to track this, but they want to track it on just like a simple kind of indicator level, what are maybe the top 2 or 3 out of everything you just mentioned? You would say, yeah, watch these 3 carefully.
Yeah, perfect. So I'll actually give you a couple of free sources that could help too. Awesome. So CoreLogic releases its, indexes of growth. So that's the end outcome, price growth shifting on a monthly and quarterly level, which people are wanting to see. Mm-hmm. The second thing you can check out is go to SQM Research and you can see stock levels, listing levels. If established listing levels start to decline, that's going to aid inventory. And if I'm not mistaken, CoreLogic would also start to show volumes of sales as well in some of their housing updates. If that starts to increase, then that's great. And then ABS will also start to demonstrate people movement. And if that people movement negative trend it continues to improve like it has been for 3 years in a row, even though it's still negative on internal migration, that's another good sign. So these are just some initial good signs that are there that have started to stabilize, although they're not crash hot, hence why it's not booming, but they've started to stabilize and hopefully turn the corner.
Okay, so stock levels, sales volume, and population. Those are the 3 main ones. If you can really monitor those, that'll help you kind of really understand as it's starting to turn. It's obviously not a panacea that's like the perfect predictor, but that'll get people on the right path.
Yeah, and if you're looking at that and you can see the speed of sale, the days on market start to shift, if you can see 1 year price growth start to shift, all of these things are positive signs then for that city to truly start shifting.
Love it. Is there any final words of wisdom or anything you wanted to leave everyone with today, Arjun?
Yeah, I'd say that, as each month goes on, median prices, even though, yes, Melbourne, people will say Brisbane's more expensive than Melbourne or Adelaide's soon to be more expensive than Melbourne. Don't get stuck on those because the truth is, you can't get pricier properties in those cities than Melbourne. Melbourne does have higher price point properties, like in the Turax, you have $100 million homes and things like that. So I wouldn't just go assuming that those cities are more pricier. It's just a median calculation. Mm-hmm. But yes, that will create excitement across the uneducated too, right? They're going to see, hey, I think Melbourne's a great deal. And now Melbourne's cheaper. Hey, honey, do we now move to Melbourne because it's cheaper? And we're already starting to see that across many things. And I just feel that when you're looking at it, Melbourne's value in terms of investor eyes, lack of growth, rental yield improving, start to see the actual local price points being more, affordable at that viewpoint I've just shared. Adelaide's now going to surpass Melbourne's median price point anytime soon in the next 1 or 2 months. So all of these things, they just have a psychological effect, right? And they make people think of the city more. At the end of the day, though, some of those indicators I've mentioned, if they truly start turning, that's a new cycle shifting, right? And we also have to remember the economic landscape as well needs to start shifting. It has been okay. I mean, when I say okay, out of the 8 capital cities, we've ranked Melbourne number 3 for infrastructure per capita. So that's pretty good. It's on that top quartile. Unemployment's just a little bit above the national average. So not too bad, but not crash hot. Mm-hmm. Job ads have dropped off a fair bit. They're nowhere near their peak levels, but a lot of cities aren't at their peak levels. Some are still strong. So I'd say we're still missing that economic strength, which we hope would return as time goes on. And I think obviously there's a lot of governmental issues there too, from costs and taxes, but rents are rocketing through the roof. And that's no doubt going to reduce the impact of these costs, and some of these trends will change as time goes on.
Yeah, mate, we haven't even unpacked the political landscape. That's a whole nother episode in itself. But otherwise...
Well, look, all I'd say on that political part is whatever you think today is rough.
Yeah.
Don't always think that will disappear. Think that others will follow along. So everyone thinks that, this is really rough and people will take away these costs and measures one day. Mm. That's not an investor mindset. An investor mindset should be, I assume the worst case scenario.
Oh, I get you. Yeah.
So your worst case scenario should not be that. Your worst case scenario should be the whole country will follow Victoria's leads. All governments will one day tax crazy stuff all over the centers of Australia. So I think from that perspective, if you look at it that way, your investing mind starts to shift as well. And you don't think one is better than the other, because I promise you, everyone will catch along and think that if they can get away with it, why don't we try getting away with it?
I don't want to agree with you, but unfortunately I do. I feel like we're ending it on a somber note now of more potential taxes. But Arjun Paliwal, as always, mate, you're an absolute wealth of knowledge. Thank you so much for jumping on the show.
Anytime, my friend. Take care.
I keep looking at this as like are you too early, too late kind of thing. It's like the way that I'm kind of looking at Melbourne, looking at Perth, like is the party about to stop with Perth? We've made some content on that recently, and lots of people like with our, was it top 550 under, or top 51 under 550. Look at how much those markets have already moved just in the space of like the 4 to 6 weeks it's been since we made that. But like listening to all of the experts, it's like it's not just going to like drop off and just go like kaput. I'm kind of listening to that same kind of advice like in the reversal of what Arjun's saying here. Probably not just going to go and just like absolutely shoot up and just double. So it's like, are you too early to the party? Well, define too early. And the way that he's looking at this is like, you're absolutely early, but how early is too early? If you can get into a market that maybe isn't going to go for another 2 years, but then you could potentially enjoy some amazing growth after that, was it too early? Or did you time yourself in a way that you didn't get into a market that maybe was at the end of the cycle? And this is where it really comes down to that personal choice. Because some people will look at it and go, no, I'd rather get in and maybe I'm going to get out of the other market. Just really time this, because that could be 2 years of wasted growth. But everyone's going to be different. I really hope you've enjoyed this panel, because looking at this from, we've actually never done it like this before. Looking at this from a mortgage broker's perspective, an accountant's perspective, a growth-focused buyer's agent's perspective, a developer's perspective, and a very data-driven buyer's agency's perspective. That's 5 different experts, and everyone on this panel, just clarifying, has built massive portfolios, multi-millions in most cases, in the tens of millions of dollars. So these people aren't bean counters that have read a few cool books and just reciting stuff. These are the people that have walked the talk and built amazing businesses around them to help more people do the same thing. So if you want to get in touch with anyone that's been on the panel today, click link in the show notes below. That all the contact details will be there. And let me know what you're wanting us to do a panel on next. We've been getting a few for like property management and choosing the right PM, getting a whole bunch of different PMs from around the country. Totally happy to make it. And I'm getting so many messages from you guys on Instagram now, and heaps of comments on when you're watching on YouTube. Tell us more of what you want, and me and the team will make it. But otherwise, guys, that is enough from me today. My name's Todd Sloan. This is the Pizza Property Podcast. As always, have yourself an amazing rest of the week. Stay awesome.